How the rich are preparing for 2026 using Buffett's investment secrets. As 2026 approaches, investors are facing a complex financial landscape: rising inflation, global economic uncertainty, interest rate fluctuations, and evolving technology trends. The headlines are full of warning, speculation, and fear, but the wealthy don't react emotionally, they act strategically. Their secret: Warren Buffett's timeless investment principles. Buffett's approach is not about chasing short-term hype or attempting to time the market perfectly. Instead, it focuses on value, patience, and understanding the underlying economics of businesses. He studies human behavior, market psychology, and long-term economic trends to make decisions that compound wealth over decades. In this video, we'll explore how the rich are preparing for 2026 using Buffett's investment secrets. We'll cover the mindset that separates disciplined investors from the herd, historical lesson from Buffett's decisions during crises, step-by-step, sector-by-sector investment strategies for 2026, practical risk management checklists, investor mindset exercises, and implementation plans. By the end, you'll have a roadmap to think, act, and invest like the wealthy, positioning yourself to thrive even in uncertain markets. Buffett's core principles and the rich mindset. The wealthy approach, investing differently, and the foundation of this mindset comes from Buffett's principles. 1. Value investing. Identify businesses where the intrinsic value exceeds the market price. In 2026, this will mean focusing on companies with strong fundamentals, predictable revenue, and essential services, rather than chasing trends or social media hype. 2. Patience. Buffett emphasizes long-term thinking. Wealth is built by holding high-quality investments over time and letting compounding work its magic. Short-term market movements are distractions, not opportunities. 3. Durability. The rich invest in businesses that can withstand market cycles, competition, and disruptions. These are companies with strong brands, loyal customers, and essential products or services. 4. Independent thinking. Don't follow the crowd. The wealthy analyze fundamentals and act based on rational research, not market sentiment. This independent mindset is crucial for navigating the challenges of 2026. 5. Capital preservation. Protecting what you have is as important as growing it. Buffett maintains liquidity, ensures a margin of safety, and avoids unnecessary risks. By adopting this mindset, the rich are positioning themselves for long-term success, even amid market uncertainty. Historical lessons from Buffett's past crises. Buffett's past decisions during market crashes reveal patterns that can guide investors in 2026. The dot-com bubble, 2000. During the late 1990s, tech stocks soared on hype rather than profits. Buffett avoided speculative internet companies, focusing instead on Coca-Cola, American Express, and Gillette. When the bubble burst, his portfolio remained stable. Lesson for 2026: stick to fundamentals, avoid hype, and invest in durable businesses. The 2008 financial crisis. Fear dominated global markets. Many investors sold in panic. Buffett, however, invested in Goldman Sachs and Bank of America, acquiring stakes at discounted prices. As the economy recovered, these investments generated massive returns. Lesson: crises create opportunities for those who are prepared and patient. COVID-19 market crash, 2020. Pandemic uncertainty caused a sharp market decline. Buffett kept cash reserves and selectively invested in companies with strong balance sheets, durable moats, and essential services. Lesson: patience, preparation, and strategic deployment of capital allow investors to thrive during unexpected shocks. Key sectors for 2026: Buffett-inspired choices. Based on historical patterns and Buffett's current portfolio, These sectors are likely to attract smart money in 2026. 1. Consumer staples. Essential products, food, beverages, and hygiene remain in demand regardless of economic cycles. Examples: Coca-Cola, PepsiCo, Procter & Gamble. Why it works: predictable earnings, brand loyalty, and recession resilience. 2. Healthcare. Aging populations and growing medical needs make healthcare essential. Examples: Johnson & Johnson, Medtronic, Pfizer. Why it works: demand remains strong even during economic downturns. 3. Financial institutions. Well-capitalized banks, insurers, and payment systems provide steady earnings and opportunities during market dips. Examples: Bank of America, J.P. Morgan Chase, Berkshire Hathaway Insurance subsidiaries. Why it works: benefit from rising interest rates and cyclical economic growth. 4. Energy and renewables. Utilities and renewable energy projects provide stable cash flows and long-term growth. Examples: NextEra Energy, Duke Energy. Why it works: rising energy demand and global focus on sustainability. 5. Technology infrastructure. AI, cloud services, digital payments, and cybersecurity deliver essential and recurring revenue. Examples: Apple, Microsoft, Visa. Why it works: high-quality tech is resilient when revenue is predictable. Step-by-step investment strategy for 2026. The wealthy follow a disciplined approach. Here's a step-by-step guide. 1. Audit your portfolio. Identify high-quality holdings and reduce speculative positions. 2. Maintain liquidity. Keep cash to deploy during market dips. 3. Analyze fundamentals. Study earnings, debt levels, and market position. 4. Diversify strategically. Spread investments across resilient sectors without overcomplicating your portfolio. 5. Buy during dips. Deploy capital incrementally when stocks trade below intrinsic value. 6. Think like an owner. Understand the business, its management, and long-term prospects. 7. Monitor and be patient. Ignore short-term noise. Focus on long-term compounding. Risk management checklist. Buffett-inspired risk management ensures protection and opportunity. Avoid over-leveraging. Debt magnifies risk. Focus on companies with low debt-to-equity ratios. Ensure a margin of safety before buying. Avoid speculative trends like meme stocks or highly leveraged startups. Reinvest dividends and cash flow during downturns for compounding growth. Timing strategies for 2026. Timing is not about predicting exact market moves. It's about strategic deployment. Market dips. Buy high-quality companies when fear temporarily depresses prices. Earnings signals. Look for short-term drops in otherwise strong businesses. Macro shifts. Interest rate changes, sector rotations, and policy shifts create tactical opportunities. Incremental investment. Deploying capital gradually reduces risk and maximizes flexibility. Investor mindset exercises. The right mindset separates disciplined investors from reactive ones. 1. Long-term perspective. Plan a 10-year vision for your portfolio. 2. Emotional discipline. Track emotional reactions to news and respond rationally. 3. Independent thinking. Question trends and analyze fundamentals. 4. Patience practice. Hold quality investments for the long term. 5. Opportunity-oriented thinking. Reframe market dips as buying opportunities. Practical sector implementation plan. Consumer staples. Focus on companies with brand power and resilient cash flow. Track earnings stability and dividend consistency. Healthcare. Prioritize companies with recurring demand and multiple product lines. Avoid reliance on a single drug or regulatory-dependent product. Financials. Target well-capitalized banks and insurers during downturns. use temporary market dips to acquire undervalued positions. Energy and renewables. Invest in utilities with stable dividends and strong infrastructure. Consider renewable projects with government contracts or long-term agreements. Technology infrastructure. Invest in companies providing essential services with recurring revenue. Avoid highly speculative startups with unpredictable cash flow. Lessons from Buffett's past stock picks. Examples of Buffett-style investments to emulate in 2026. Consumer staples: Coca-Cola, PepsiCo, Procter & Gamble. Financials: Bank of America, J.P. Morgan Chase, Berkshire Hathaway Insurance. Healthcare: Johnson & Johnson, Medtronic, Pfizer. Energy: NextEra Energy, Duke Energy. Technology: Apple, Visa, Microsoft. Principle: invest in durable, undervalued, and essential businesses. Turning knowledge into action. 1. Audit your portfolio for strength and durability. 2. Maintain liquidity for opportunistic purchases. 3. Allocate strategically across resilient sectors. 4. Evaluate fundamentals before investing. 5. Think like an owner and hold long-term. 6. Execute with patience and discipline. By following these steps, you align your strategy with Buffett's approach and the behavior of the wealthy preparing for 2026. Your 2026 ed. Markets will fluctuate. Headlines will trigger anxiety. But Buffett teaches that opportunity comes from preparation, patience, and principle-driven investing. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. By internalizing these principles, 2026 can become a year of strategic growth and wealth accumulation. The rich aren't reacting to fear. They're acting with knowledge, discipline, and foresight. Risk management checklist: protecting capital the Buffett way. Investing without managing risk is like sailing a ship without a compass. Buffett's approach emphasizes protecting capital while remaining ready to seize opportunities. Here's a comprehensive risk management checklist for 2026. 1. Avoid over-leverage. Borrowing to invest magnifies both gains and losses. The wealthy maintain low debt levels and avoid margin overexposure. For 2026, this is particularly important as interest rates may fluctuate. 2. Debt-to-equity evaluation. Only invest in companies with manageable debt. Low-leverage firms survive downturns better, while highly leveraged ones risk insolvency during market shocks. 3. Margin of safety. Always purchase stocks below intrinsic value. This provides a buffer against unexpected downturns. Buffett repeatedly emphasizes, price is what you pay, value is what you get. 4. Avoid speculative fads. Meme stocks, highly volatile tech startups, and unregulated crypto can deliver quick returns but carry extreme risk. Smart money focuses on predictable, understandable businesses. 5. Diversification without dilution. Spread investments across resilient sectors but avoid over-diversifying, which can dilute returns. Buffett's strategy is about concentrated quality, not scattershot quantity. 6. Liquidity maintenance. Keep a cash reserve to act decisively during market dips. Historically, Buffett's ability to deploy cash during crises like 2008 and 2020 created enormous advantages. 7. Dividend reinvestment. Reinvest dividends and cash flow during downturns to take advantage of discounted prices. This accelerates long-term compounding. 8. Scenario planning. Conduct what-if scenarios to anticipate market shocks. How would your portfolio perform during interest rate spikes, geopolitical crises, or tech disruptions? By following this checklist, investors protect capital, reduce emotional reactions to volatility, and position themselves to turn crises into opportunities. Timing strategies for 2026. When to act. Timing doesn't mean predicting exact market moves. It's about strategic deployment and patience. 1. Market dips as opportunities. Fear-driven sell-offs temporarily reduce prices of quality companies. The rich buy when prices fall, not when they soar. Example: 2008 financial crisis. Buffett bought Goldman Sachs at discounted preferred shares. 2. Earnings-based signals. Temporary dips in earnings or market overreaction can create acquisition opportunities. Focus on fundamentals rather than short-term sentiment. 3. Macro shifts. Interest rate changes, inflation trends, and policy updates create tactical opportunities. Investors should monitor Federal Reserve statements, GDP growth trends, and sector rotation signals. 4. Incremental deployment. Instead of investing a lump sum, deploy capital gradually across market dips. This reduces timing risk and ensures flexibility for unforeseen opportunities. 5. Opportunistic rebalancing. Periodically adjust holdings to allocate more capital to undervalued sectors, while reducing exposure to overvalued ones. Buffett's timing strategy is opportunity-driven, not prediction-driven, giving investors a systematic edge for 2026. Investor mindset exercises. Thinking like the wealthy. Your mindset dictates your ability to implement Buffett's strategies. Try these exercises. 1. Long-term perspective exercise. Write down a 10-year vision for your portfolio. Identify which sectors and companies align with sustainable growth and stick to that vision, ignoring short-term noise. 2. Emotional discipline exercise. Track emotional reactions to news headlines for 1 month. Note when fear or excitement influences decisions and create a plan to respond rationally. 3. Independent thinking drill. For every investment, challenge the crowd's opinion. List reasons why it's undervalued or overvalued based on fundamentals, not hype. 4. Patience practice. Review past investments. Identify which ones would have generated higher returns if held longer. Commit to holding high-quality companies through volatility. 5. Opportunity-oriented thinking. For every market downturn, make a list of high-quality companies whose prices dropped. Practice identifying the ones that represent real long-term value. These exercises strengthen mental discipline and prepare investors to act decisively, calmly, and profitably in 2026. Practical sector implementation plan, step by step. Here's a sector-by-sector guide to implement Buffett's 2026 strategy. Consumer staples. Target companies with strong brands, predictable revenue, and dividend consistency. Monitor sales trends during economic slowdowns. Brands like Coca-Cola and Procter & Gamble have historically remained resilient. Deploy capital gradually when market dips create opportunities. Healthcare. Focus on companies addressing aging populations, chronic conditions, and medical innovation. Diversify across pharmaceuticals, medical devices, and healthcare services. Look for recurring revenue streams to weather short-term downturns. Financials. Invest in well-capitalized banks, insurers, and fintech companies. Monitor interest rates and credit quality to anticipate sector resilience. Historical data shows financials often provide long-term returns when purchased at market stress points. Energy and renewables. Utilities provide stable cash flows. Renewable energy benefits from government incentives and long-term demand. Evaluate dividend sustainability and project pipelines before investing. Gradually acquire positions during short-term market fear to optimize entry points. Technology infrastructure. Target companies with recurring revenue, essential services, and high switching costs. Cloud services, AI infrastructure, payment processors, and cybersecurity are likely winners in 2026. Avoid speculative tech with uncertain revenue. Focus on durable, revenue-generating platforms. Lessons from Buffett's past stock picks, blueprint for 2026. Examples of investments the wealthy emulate using Buffett's strategy. Consumer staples, Coca-Cola, PepsiCo, Procter & Gamble. Financials, Bank of America, JP Morgan Chase, Berkshire Hathaway Insurance subsidiaries. Healthcare, Johnson & Johnson, Medtronic, Pfizer. Energy, NextEra Energy, Duke Energy. Technology, Apple, Microsoft, Visa. Principle, the focus is always on durable, undervalued, and essential businesses. 2026 is no different. The rich look for companies that solve real problems and generate consistent cash flow. Turning knowledge into action, implementation roadmap. Here's a practical roadmap for executing Buffett's strategy in 2026. 1. Portfolio audit. Identify core holdings with durable competitive advantages. Trim speculative or high-risk positions. 2. Liquidity planning. Keep cash reserves to deploy opportunistically. 3. Sector allocation. Invest strategically across consumer staples, healthcare, financials, energy, and tech infrastructure. 4. Fundamental analysis. Study earnings, cash flow, debt levels, and management quality before investing. 5. Long-term commitment. Resist short-term panic. Let compounding work. 6. Incremental investment. Deploy capital gradually across market dips. 7. Continuous monitoring. Track sector and macroeconomic trends without reacting emotionally to every news headline. 8. Mindset discipline. Use mental exercises to maintain focus, patience, and independent thinking. The market will fluctuate, headlines will panic investors, and speculation will tempt the impatient. But Buffett's approach shows the path of the disciplined, patient, and principle-driven investor. Focus on quality over hype. Prepare for volatility without panic. Seek opportunities in downturns rather than peaks. Think like an owner, not a trader. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. For 2026, your edge is preparation, patience, and execution. The rich are not reacting to fear. They're acting with knowledge, discipline, and foresight. By internalizing these principles, you can position yourself to thrive in uncertainty and build long-term wealth. Comment your thoughts on Buffett's 2026 strategy. Share with friends and fellow investors. Subscribe for more insights from the world's smartest investors. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before making investment decisions. Investing carries risk, and past performance does not guarantee future results.